What's up, guys? Welcome to this week's Markets in Focus. It is November 3rd, Friday morning, bright and early, 8:12 a.m. Eastern Standard Time. Obviously, we still have the entire Friday session to trade, so take this with a grain of salt here. But looking at this week, man, what a powerful move in the markets. What an insane counter rally. Is it a reversal? Not entirely sure yet, but we are starting to take positions to the long side, so let's get into it. First things first, the Qs. The Qs are up 5.76% over the last week, absolutely annihilating anybody that has been short this week, potentially last week. Growth has absolutely begun to find a floor and start to rally. Is this a counter rally once again, or is this the beginning of the next move up? It's impossible to say 100% sure right now, but there are clues. And like I said, we are starting to accumulate some small positions in longs. We're going to talk through those in a second. Over the last 3 months, we are still down. It goes to show you just how powerful this downtrend was over the last 3 months. It has eviscerated breadth, right? SPY came down over 10% into technical correction territory. The Qs held up a little bit better. We did expect them to come down and hit the 200-day moving average as well. They never got there. That's okay, right? Now we're starting to move back to the upside. Was that the floor? Obviously, this year has not been a good year to short stocks. I mean, let's just call it as it is. The last 3 months, even then, were not necessarily easy to short stocks. You had to be aggressive. You had to be opportunistic because there were counter rallies every few days, right? I mean, you'd pop down and then counter rally for a few sessions and pop down and counter rally. You really had to be on your P's and Q's if you were looking to short. Over the last 6 months here, the Q's still up 14.12, even after the correction. That's how powerful stocks, specifically growth stocks, have been this year. Have we found the floor? Once again, there's some writings on the wall. I don't want to try to predict here, but we are starting to accumulate long. So once again, Q's up 5.76, S&P 500 up 4.36. Even got small caps rallying off of their 3-year low, 3.49%. Now, we don't necessarily need small caps to lead, but we would like them to be moving generally in the same direction as the rest of the market. That old school Dow theory where we want all the major indexes flowing in the same direction. Small caps don't have to outperform, but man, it's going to be nice to see them at least stop going down, right? At least stop going down, signal a little bit of risk coming back into the market on that small cap space. Let's talk about the most important asset this week, bonds, TLT in particular. Have we found a floor? Bonds are up 3.08% over the last 6 months, eviscerated 18% to the downside. Bonds, a little bit of a bullish divergence. We're going to look at that in a second. Did they catch a bid? We know we're in a market right now where bonds and equities are moving in the same direction. They're positively correlated. We want bonds to break to the upside if we expect equities to break to the upside. And as of right now, over the last few sessions, they are very, very positive price action in bonds. Gives us a little bit more confidence with those equities plays. And then Bitcoin. Let's talk about it. Yearly high, right? $35,000. There's really not a lot to hate about Bitcoin right now. Lots of different trading vehicles in the equities market. Riot, Mara, Coinbase, GBTC, MSTR, HUT, even I think CleanSpark, right? We found that one out. It's moved out of the solar space and into the Bitcoin mining space. These names are moving right now. Incredible opportunities if Bitcoin continues to break to the upside. If liquidity starts coming back into the market, specifically the growth market, we expect those Bitcoin positive correlated assets, right? The equities to move incredibly high, right? Just last June or July, a few months ago, we saw Riot hit $20. It's currently under $10 right now. Go buy it if you expect Bitcoin to go up. They're positively correlated. So once again, you can see it's been a fantastic week, right? Crude is down, helps with some of that inflation scare. We see yields coming down, bonds popping up, equities popping up. This is kind of a Goldilocks scenario right now, but can it hold, right? That's kind of the big question. We're going to look really quick at US sectors. I just want you to look at the sector and industry moves just to point out which areas of the market are really moving the most. So if we go back to the last 3 months, you can see which areas have performed or at least held up the best during the last drawdown. If we go back and we think the market peaked around the end of July, beginning of August, right? So we can see which sectors have held up the most, but look what's happened over the last few sessions, right? We've started to pop back up. Look at everything that's outperforming SPY on the 3 month. This matters. In particular, look at communications and look at technology. These are your QQQ areas. These are your Apples, your Microsofts. These are your Googles, your Metas, etc. These are starting to pop back up and show a little bit of signs of life. Let's look at the 5-day. The rally started just a few sessions ago. Well, we're going to look at a picture in a second. Did it start on Friday? Was Friday the low? If we look here, yeah, kind of. We're going to look at this historically in a second. Look what's leading. The growth areas of the market. Consumer discretionary, which is your Amazons and your Teslas. Tech, which is once again your Microsoft and your Apples. And communications, which are your Googles and your Metas, right? These are the areas of the markets that have led all year. These are the areas of the markets that are leading off of that potential October 27th low. So as a discretionary trader, maybe you should be looking at owning something within those 3 spaces. Once again, bringing it down to an industry level, right? So we're subsector sectioning out the sectors and we're looking at even a smaller nuanced portion of the market in these industries. Energy over the last 3 months has held up relatively well. Hasn't been the easiest trade, but still up there, right? But we can see some of the turnarounds. Software, right? The October 27th potential low. You see there's a tick up here on the 3-month chart within software. You can see it in the internet's names as well, right? Starting to kick back up. Still underperforming over the last 3 months, but they're starting to kick up. Let's look at the 5-day and you can really start to see what's leading. Semiconductors. Huge, probably the most important industry this year. Nvidia's, everything else, the whole AI theme. This is a huge component of your tech sector. So yes, if semiconductors are up, we can assume that tech is also going to be up as well. So we're going to want to try to pick and choose our spot here with semiconductors. Maybe it's Nvidia. I'm not entirely sure yet. We need to make that decision inside of TTI. Home builders, another industry group which has led all year, is leading once again. So we're starting to see a different, a change in sentiment. No more are we defensively posturing like we have the last 3 months. We're starting to buy the areas that led last year or this year, right? Earlier this year. We're starting to rebuy them. Should we be owning them through November and December into January? Potentially, right? Potentially. So that's it. I want to show you from a US sector standpoint. The next thing I want to show you are 3 pictures from our monthly chart-a-thon. If you think you could benefit from this, it's free right now. I'll link the video in the description below. Feel free to check this out. It's about a 45-minute chart blitz where we look at the most important charts in the market from a weekly and monthly time frame. It really sets the tone, the pace, the framework for the next 2 to 3 months out there. So if you want higher level type stuff, right? If you're a swing trader and you want a group that's dedicated to finding ideas in different areas of the market that are going to possibly be outperforming over the next 2 to 3 months, click on the link below. It's free. Sign up, watch the video, and you're going to be leaps and bounds ahead of everybody else. 3 of the most important charts within this monthly chart-a-thon, though, that I want to point out are all positioning based. This chart to the left here, this NAAIM Exposure Index Monthly, shows that the lowest yearly exposure for money managers right now. You can see the S&P 500 and the fact that the money managers were running for the hills during this corrective phase in the S&P 500. If that was the low last Friday on October 27th, you have literally a record amount of CTAs that need to reposition themselves long. What does that mean? It means they're going to be chasing price to the upside, which if you're long right now, if you're starting to position yourself long, is once again part of that Goldilocks scenario. All of this liquidity potentially is going to be chasing the rally, causing obviously a lot more buy side pressure to come in, pushing the prices up even more and more and more. And that's what we want if we're long, right? So once again, lowest yearly exposure for CTAs. We absolutely love that. If you are privy to the commitment of traders reports, you don't absolutely need to know everything about this. Just know that this picture shows that leveraged funds, aka short-term speculators, we're talking hedge funds, retail traders, etc., the people that are speculating on shorter term price movements are net short the S&P 500. So once again, they got caught off sides. Once again, we have record lows CTA exposure to the long side, and we have not record, but a lot of people that are short the S&P 500. A lot. What is that? Like, how does that play into it? Well, if the S&P 500 rips, now all of a sudden you have all of these people getting squeezed. They're going to have to cover their shorts, which obviously causes more upside pressure. Last one here, the put to call ratio, right? I just want to point this out. Puts were sold off last week at a very, very fast pace and calls were bought. Is this smart money positioning themselves for a potential rally? Not just, a counter trend move, but a rally into potentially new highs. It could be. We're extrapolating here a little bit, but it is to show you that smart money covered puts last week into those October 27th lows, and this put to call ratio is normalized around 1 once again, right? This is what we want to see as part of a potential move to the upside. So all 3 of these things are kind of pointing in the same direction, right? People are fucked. They're not positioned correctly for if this does turn into more than just a counter rally. So we're going to look at 3 or 4 different things here very quickly. Bonds, right? This is the chart that is probably the most important. We know if you've been following the content that we were down here near all-time lows in TLT. Really quick, put this in reference right there, right down here at the lows. We were right there. Was that the bottom for bonds? We started to notice about 2 weeks ago that there was a bullish divergence forming within TLT. Bullish divergence meaning lower lows in price, higher lows in the RSI, and here we are. We're gapping up. We want to own TLT above 88. We have some traders that have been positioning themselves within TLT over the last week and a half due to the bullish divergence, but above 88, we're starting to potentially hit higher highs. Finally, name of the game here though is bonds go up, equities tend to go up. We want to continue to watch this because this is, the fuel for the equity rally, right? These are moving in tandem. What about the dollar? Probably the most important chart over the last year and a half. We know that the dollar and equities are inversely correlated right now, meaning when the dollar goes up, equities are coming down, and when the dollar comes down, equities are going up. We're holding above 105.5, so we're not out of the woodwork yet, right? As long as we're holding above 105.5, we have to be slightly cautious, but we do expect that if the dollar breaks back down below 105.5, back into this range that we were in, if you look at the dates here, the dollar went sideways is, what did the market do the entire year? It went up. So if the dollar starts to break back down into this range, we expect the market to rip. And right now we're down, right? We've been down the last few sessions and the dollar hasn't really done anything over the last like month and a half, right? Since the beginning of October highs, we're now a month plus into this sideways consolidation range with the dollar. Once again, not out of the woodwork, but we're watching this 105.5 area. We expected if we break down here, equities are going to absolutely rally. There will be a tailwind to stocks. And obviously the other side of the equation comes into play. We rip above 107 and hold it. I think this Goldilocks scenario is out of the window. The dollar matters so much right now. Looking at the rallies here in the indexes, you see this is still technically a period of lower highs. We're going to have to clear above 435, 436 in SPY before you can really call this, the next leg up potentially, right? Let's just call it out how it is. We're technical traders here. We're not going to take hope and turn that into a trading vehicle, but we want to see the indexes hit higher highs here. And on an absolute basis, that's going to be that 435-ish area in SPY, and the Qs are no different, right? The Qs are in a period of lower highs as well. We want to see the Qs up and over this 370 area. As of right now, this is a great start, right? We see the RSI breaking above the 50, but it did it twice before as well. So could this be an epic counter rally, right? And into new lows into the end of the year? It could be. We don't think so because of the positioning and some of the breadth improvements we've seen, but we have to call it as it is. Until we're making higher highs, this is still potentially a very cautious time to be in the market when you're looking to go long. So we are starting to take some longs. I'm going to go ahead and go through 3 really quick with you. Okay, this is from our monthly chartathon. Once again, if you want this type of info, it's free right now. Click the link below. Meta is the stock we want to own within the communication space. Every other stock over the last 3 months has gone down. Meta has gone sideways. We have a very clear risk on level at 325, and we want to target this up towards previous all-time high at 380, 385, then potentially the 400, all the way up to 472 in a perfect scenario. Will it absolutely do that? Maybe if you buy enough time, but we're really looking for a break above 325 with a retest of all-time high. And if we get that all-time high, we're going to continue to try to maintain our position in Meta up towards that 472 area. You can see that the RSI has relatively been one of the strongest I've seen all year in any stock, right? The market doesn't want to sell Meta. It's not up for us to decide why. It's just up for us as technical traders to identify strength, identify trend, and take a position when we can clearly define our risk, which for us is at 325 area. Microsoft is the next stock we want to own, absolutely killing the tech space. Everybody wants to own Apple. It's down right now due to ER, but even prior to ER, Microsoft has outperformed Apple almost all year, right? We're pressing up into all-time highs. We're up and over the previous all-time highs last year. Very easy, identifiable area to risk. We like above 350. We've already started accumulating this Microsoft position. Above 350, we want to own Microsoft for a potential test at 400 and then 435-ish, right? We want to get rid of this stock if we start trading below this support level, right? So we're already starting to position ourselves. We're looking for about a 4-to-1 setup here on this Microsoft trade. You can see RSI confirming that the market does absolutely love Microsoft at all-time highs. If this does turn into a bigger rally, we expect Microsoft to be one of, if not the biggest and best performers in the software space for a large cap. Last one we want to look at here is CrowdStrike. Once again, it's just a very easily definable position. We wanted to get long on a pullback, so we are getting a pullback here slightly pre-market. We wanted to get a 170 pullback. I'm not sure if we're going to get that. We're still going to try to grab CrowdStrike if we can find an options trade that gives us a 4-to-1 setup. And for equities, guys, a lot of them are already in, right? We like this off of the 170 pivot targeting the 218. This is a market leader, right? Market leader all year in the cybersecurity space. We absolutely like it. We want to own it from 218 or up towards that 218, 220 area. We want to enter off of the 170 pivot, and we want to get out if we at this point fall below 170, right? We're already clearly above 170. We bounced off it. We want to get out if we're falling back below. And once again, just like Meta, check out that RSI. The market does not want to sell this all year, right? Ebbs and flows as indexes come down, but realistically, the market is not capitulating on CrowdStrike for whatever reason, and therefore we want to own it, especially because there's an easily defendable area of resistance and support here at this 170 area, which we can use for risk. Okay, guys, that's it for me, right? We are cautiously optimistic into this rally. Is it the beginning of the next leg up, or is this just a counter rally? Impossible to know, but we are cautiously optimistic. We are starting to take some longs here. We're dipping our toes in because, hey, if it does end up being just a new rally to new highs, we don't want to miss potentially some of the best entries we can possibly get while people are still throwing shorts at the market. That's when this stuff really pays out. All right, my name is Hamilton. I'm here with the Trading Initiative. Once again, monthly chartathon below. Feel free. It's free. If you like this type of content, please like and subscribe, leave a comment below, and I'll catch you in the next one.